Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm in a good mood today, but first, let me introduce our host, Robb Fahrion. He's the CEO and founder of Flying V, Deep Knowledge Investing's digital marketing partner. Robb, how are you today?
I'm doing great, Gary. Coming off a Thanksgiving week, been nice to get a little R&R over the last couple of days, gearing up for the holiday seasons. But yeah, I know we have this. The consumers are revolting issue, but we were actually considering changing the title to Michigan beats Ohio State again issue. And I know you're in a good mood. Obviously, a big win for the Blue yesterday, and as we can see from your shirt and your smile. You're having a great Sunday as we're recording this.
It's true. It was a fantastic game. Michigan sent their entire team, their entire coaching staff to the NFL. They were playing with a walk-on quarterback, missing All-American cornerbacks, All-American tight ends. Didn't matter. Ohio State spent $20 million in name, image, and licensing money on buying an NFL quality roster themselves, and it didn't matter. In the end, the game was won in the trenches. I think Ohio State gained something like 7 yards in the fourth quarter.
Crazy.
Michigan was just tougher, lasted longer. I know the Ohio State fan base is really upset. They're talking about firing Ryan Day, who is 47
Yeah,
and 1 against the rest of the Big Ten and 1 and 4 against Michigan.
that's
Uh,
right.
I please don't fire him. Please keep him. We would love to see him again in 364 days.
Yeah, we'll probably have some virality. This will be the one thing that will go viral on this show up until this point is Deep Knowledge Investing's take on Ryan Day. Gary is asking and pleading, please, Ohio State, do not get rid of Ryan Day. That would be a terrible, terrible decision.
Yes,
But yeah, I thought
and
it was
to the
great. You're exactly right. Like Michigan just over and over and over and over again in the trenches, 3 yards, 4 yards, 3 yards, 4 yards, 3 yards, 4 yards, right? Just that compounding interest of return is what it reminded me of.
Yeah, they did nothing. That Michigan's offense did nothing in the second and third quarter. They looked like they were just I don't think they had a first down between something like, early in the second quarter all the way through the third quarter. And then, in the fourth quarter, 2 long drives, they just put it together. If you're one of the two Ohio State fans who have made it this far into the episode, please put in the comments your view on whether Ohio State should fire Ryan Day or not. We'll be interested in your opinion, but I'm begging you guys, please keep him. Congratulations to Sharon Moore and the entire Michigan team for coming through in a huge way. And if we're not going to be back-to-back national champions, at least we'll have the satisfaction of knowing we've ruined Ohio State season.
Yeah, this is probably just as sweet knowing that this rivalry is one of the biggest in America. So great stuff. Gary's in a good mood. Let's get into it. The 5 things to know in investing this week. Thank you so much for joining. Joking aside, this issue is called the Consumers Are Revolting issue. We're talking PCE, luxury items. Dell makes an appearance in this week's episode. And then, as always, we're going to talk a little bit about investment tips, advice, and some questions that have come in a response for the 5th thing. Gary, thing number 1 to get us started. As we're mentioned, we're talking the PCE. It joined the PPI and the CPI as those indexes that have risen following the Fed rate cut. Thing number 1, Gary, hot PCE inflation remains high.
All right, Rob. So we've explained before that the PCE stands for the Personal Consumption Expenditures Price Index. It is the favored inflation index of the Federal Reserve. While most of the country looks to the CPI, the Consumer Price Index, the Fed looks at the PCE because it's a better reflection of consumers' actual expenditures, what they're spending, where, and how much they're spending. And that number came in line with expectations, but showed increasing inflation. So the last year, we've heard a lot about disinflation, which means we've had inflation, but at a slowing rate. Again, for those of you who remember your high school calculus, it's a second derivative calculation. In this case, the headline number increased from 2.1% to 2.3% last month. And the core number, which excludes food and energy, rose 0.1% from 2.7 to 2.8. These aren't huge increases, but they're going in the wrong direction, and it comes just 2 months after the Federal Reserve cut rates. Since the Fed cut for the first time in September, and then they did again in November, the PCE, the CPI, that's the Consumer Price Index, and the PPI, the Producer Price Index, have all risen. This is not what the Federal Reserve wanted to see. At this point, we're not saying that the Fed cut caused inflation to increase so soon. What we're saying is the Fed cut before they had inflation under control.
Gary, in the next couple of weeks, Powell's going to have another decision with the rate cuts. What's the argument for or against additional cuts? What direction do you think that's going?
So right now, the street is assuming it is more likely than not that the Fed will cut 25 basis points. The two reasons that people would argue that the Fed could and should cut is one, the recent employment numbers have been abysmal. They've been really, really bad and worse than expectations. The second reason is people understand that once you back out excessive government spending and transfer payments, the productive private market economy is not in good shape. And for most of the country, what they're seeing is a recession, and that would be the reason to cut. The reason not to, and this would be the decision I would make in that situation, is you have two things going against the Fed cutting. One is they don't have inflation under control. Not only are all of the inflation metrics they look at too high, they're increasing. And then the second thing is Congress is still spraying trillions of dollars of additional stimulus into the economy. It's not wise, but basically with Congress overspending, if the Fed cuts, they're doing double stimulus. We're going to end up with more inflation. So at this point, the Fed might keep cutting, but if we ran the Fed, we'd do one of two things. We would either hold right now and not add to congressional stimulus. Alternatively, our real desire would just be end the Fed. We do not need an organization of unelected bureaucrats who have never run a business to set the most important number in finance, which is the Fed funds rate, and that's basically the price of risk and the price of time. And the market can do that, and the market can do it more efficiently than the Fed. There's really no reason for this organization to exist.
Hashtag end the Fed. If you disagree, tell us why. Leave a comment, and I'm sure Gary will have a great response or some banter back and forth. Thing number two, Gary, we're talking luxury items, and we're seeing some weakness in that market. Thing number two, Gary, potential signs of consumer weakness heading into the holiday season.
So, Rob, let's go back to 2020, 2021. And, with the COVID shutdowns, people were not going out. They weren't spending money on vacations, on travel, on concerts, on sporting events. They weren't going out to eat. They weren't doing social things. People were pretty much holed up at home. And so rather than spend money on experiences, people spent money on goods, and the price of goods went up rapidly. The second thing that happened during that period was the government gave everybody stimmies. They just sprayed, again, trillions of dollars of stimulus into the economy. And so what people who were stuck at home did is they kitted out home theaters, home offices, did a lot of home renovations, even though it was very expensive to do at that time. And people bought a lot of luxury goods. We saw the price of handbags and shoes and watches in particular rose rapidly. And now we're seeing a reverse of that. And with all of these high-end luxury items, rather than going to the manufacturer or going to the big name brand and paying full price, more consumers are either not buying or they're seeking out discount resellers so they can buy at a discount, or sometimes buying used items. The stimmies are gone. People have run through their savings. And there's just a lack of interest in spending huge amounts of money on unnecessary discretionary purchases. Excuse me.
Gary, how much of this is the upper income levels not buying as much or not being able to prop up the economy, or is it more of the middle class that does have some crossover into these luxury spaces? They're just saying, hey, we cannot afford these luxury items, therefore they are the missing link. in what was previously propped up by some of the middle class as well in this luxury space.
It is definitely middle class spending weakness. It is not the high end. You know, Rob, one of the things that really makes me angry about the way our economy is managed is all of these policies that our politicians put in place claiming they want to put these policies in place to hurt the rich and help the poor and help the less fortunate actually do the opposite. The kind of spending that is coming out of Washington is not helping poor people. It's leading to huge amounts of inflation. Now, if you're really wealthy, what you can do is you can take your 800 something credit score and you can borrow depreciating fiat dollars and buy hard assets. You can buy things like gold, Bitcoin, land, property, buildings, homes, and you can buy real assets. You can buy stocks, right? And so you can take on debt that will be worth less when you get to pay it back or have to pay it back, and own assets that will go up in value as inflation becomes a problem. And so Washington's policies, while they claim to want to harm the rich and help the poor, do the opposite. The wealthy right now are doing fantastic because of these big spending policies out of Washington. And the poor and middle class are being crushed by inflation, and that's what we're seeing right now. This is weakness in middle class spending right now as they're being crushed by inflation. And you know, when the middle class experiences a slight increase in disposable income, those stimmy checks, they tend to spend it on luxury goods like purses and watches. But that we're seeing that effect going in the opposite direction right now. And it's something we've talked about a lot this year, but usually at the lower end. We've talked a lot about, you know, the shift toward low end retailers like Walmart. And we'll talk about that more later in this issue. But you know, we're seeing weakness in the luxury spending area that is definitely coming from the middle class. The wealthy are doing fine right now.
Yeah, definitely. My uncle's actually he's in the toy space, but distribution through retail. And he was saying, yeah, things have been extremely slow up until this point, and it's looking like very weak retail market heading into the holidays as well. And I think you've got it nailed here in the luxury space also, Gary. Anything else to add there?
No, it's interesting to hear about your uncle's situation. I see the same thing when I talk to people. So my business is relatively unaffected by this because I can do exactly what we talked about, right?
Right.
I can use leverage and buy stocks, and that works for me. And people who are investing understand that we are delaying enjoying that money right now for the opportunity to make a lot more money down the road and to build wealth. And so, you know, that works for me. But when I talk to people who are running small businesses or, you know, running their own businesses, people like your uncle, they're telling me it is just really, really rough right now. And, you know, in many ways, one of the best things that I do to learn about investing and the ideas we're looking at is I do a lot of research calls. I talk to people who run these businesses, and, you know, we're hearing this, just the same story as your uncle again and again.
Yeah, we've been talking about this for a few years, seeing it to further come to fruition here as we move into the holiday season. Wrapping up thing number two regarding the weak luxury market. As always, please head to our website, deepknowledgeinvesting.com. Sign up for a free subscription. That'll get you added to our email list. You'll receive all the content material that gets posted through the DKI blog. But you will not have access to premium paywalled content or Gary's current recommendation that comes with a membership, but we'll be sure to at least keep you in tune with the five things. That's a free deliverable that goes out to everyone on a weekly basis. And speaking of five things, moving to the third thing, Gary, we're talking about AI powered electronics and what the consumers are deciding to spend on. Dell, Best Buy make an appearance here. Thing number three, Gary, consumer tech earnings miss.
So, Rob, the reason I this point is particularly interesting to me is the big investment story for the S&P 500 and the Nasdaq 100 this year has been the performance of the hyperscalers, right? The big tech companies like Google and Microsoft, and Apple and Amazon buying enormous amounts of high-end GPUs from companies like NVIDIA. And they're spending tens of billions of dollars to be the leader in building the next successful AI business and these AI models. And so that tens of billions of dollars for AI enabled large language models and other solutions, that's driven the market all year. And we got to the point this year where we started to see cell phones and personal computers and laptops that were AI enabled, that had specific onboard AI functionality. And the reason that matters is not everybody wants to send their data to be analyzed or their requests to these companies to have it be processed on their servers. And that makes sense. We all want our privacy. We all have to protect our own data. And not everybody wants their web search history being stored at Google. And that's a totally normal, reasonable thing. But the consumer has balked and they've decided that the AI related consumer offerings are not good enough to decide to upgrade. And so what we saw was weakness coming out of Dell, where Dell reported really strong revenue and earnings from its infrastructure solutions group. Guess what? That's driven by AI demand. But they lowered their guidance for PCs. And part of the thing they cited were challenges in securing more NVIDIA Blackwell chips. And here's the key thing, slowing PC sales. We got the same thing coming out of Best Buy. They missed estimates and lowered end of year guidance. Significant misses were a huge decline in entertainment, appliances, and guess what? Consumer electronics. Basically, more discretionary goods. People have decided the AI offerings, despite these companies spending tens of billions of dollars on building out the infrastructure, isn't good enough that people are saying, I want to spend, another $1,000 or $2,000 on a cell phone or a tablet or a computer or a laptop to take advantage of it. And so we're seeing declines in estimates going right into the holiday season, not what retail wanted to see from discretionary purchases.
Yeah, Gary, we've talked about a little bit of the shift too to the discounters like Walmart. Is this a big win for Walmart? Is it just a loss in general for the overall market? A little bit of both.
I think what we're seeing here is so we talked last week about the move from brands like Target to Walmart, right? And where Target is, they sell more discretionary goods and have tried to maintain more price discipline. Walmart sells more necessities, and their whole brand is we're cutting prices. And we're now seeing that weakness, that consumer weakness that caused the shift from Target to Walmart, moving up into the more expensive discretionary items. So, rather than clothing items or, unnecessary household goods, we're now looking at, $1,000 or $2,000 computers where, Best Buy and Dell customers are saying, you know what, we don't need this. We can use our existing laptop for another year and maybe look at upgrading a year or two down the road. So I don't know that this news has anything to do with Walmart. I think what we're seeing is if what we're seeing from the consumer is a de-emphasis on discretionary purchases and a higher percentage of spending going to necessities, we're now seeing that trend being expanded into other areas, consumer electronics being the next of them.
Understood. Makes sense, Gary, there. How much too, I was curious, like with AI, actually on the business front, like we used Slack recently and they rolled out this Slack AI. And, knowing what I know about AI, obviously being a little bit more in tune, right? I go to just check out immediately and say, hey, add this to our Slack channel. It's going to integrate AI. Do you think it's a misunderstanding of how valuable AI is currently? Is it going to take some time? Or, does AI actually even have a play from a consumer basis? I'm sure it does. It's just that it hasn't been fleshed out what that actually is yet. Because for me, I couldn't pull the trigger just from a B2B sense, knowing that what exactly is this AI going to be doing on top of this software that we already have? And you're talking about a big premium, even from a service model standpoint. So I'm wondering how how reluctant or how much it will take for the average consumer to kind of get over this AI hurdle. Maybe swaying, but I'm curious how much you think it is just consumer resistance to AI.
I think for the businesses that have very specific needs and are clever in operating it, there are advantages. I had a conversation earlier this year with someone in business who gets a lot of inbound calls, and they found that by replacing their people with AI, they not only ended up with lower expenses, of course, but what they got were more appointments. The AI was more effective in answering customer questions and getting more leads to the founders of the business. And so they were able to make that work. When you go to the consumer level, when I look on Twitter or X, I always see somebody will do the thread 10 must use
Hmm.
AI applications. And I've looked at some of that. I think, if you're really good at it and you have very specific needs, maybe. But
Yeah,
right now, what they're offering I think isn't really clear to people. And so like my
right.
cell phone has a bunch of AI related features. Some of them I haven't bothered with because they don't change my life. They don't matter that much. Some of them I played around with and I've come out with, oh yeah, that's kind of cool. Like the ability to remove myself from a photo or, like if I took a photo with somebody, I could take, one person out and just make it be one person and have the background look, it's kind of cool stuff, but I don't know. It doesn't, for me, it's not life changing. It's the kind of thing that's fun to play around with. But, if I didn't have, my cell phone is a year and a half old. I wouldn't spend $1,000 or fifteen
Yeah.
hundred dollars on a new phone to access those features right now. I just say, yeah, let's just wait a few years and see what it looks like then.
Yeah, I find my phone is used for calling, texting, and email more than anything. So
Yeah.
going back to the basics.
Yeah, and here's
Wrap it
and
up.
here's the other thing. I'm like what I use my phone for a lot. If I leave the house, it's great to have trading applications on there, right?
Sure,
Market information to be able to trade things instantly.
definitely.
That's useful, but I don't need AI for that, and I'm not about to
Right.
replace my brain with that. Certainly not yet.
Interesting thing number three, wrapping up, shows weak guidance moving into this holiday season across the board in a couple different areas. Doing it a little bit differently, we're actually going to bring thing number four, our investment knowledge, advice, tips section. Discipline, emotions are obviously a big part of investing, Gary. Our question coming to you this week, thing number four this time, Gary. How do you maintain discipline while investing?
So, Rob, let's take this question apart in two different ways. First of all, let's acknowledge that it is completely normal and reasonable for people to have strong emotions when they have money on the line, right? This is a normal thing. And so, the example, my old partner from Silver Arrow, Raji Kabaz, and I, we used to talk to people about one of the things that's really difficult about being an investor is there are no minor leagues. So, think about like if you were in ancient Rome and you were a gladiator, what you could do is you could practice with a wooden sword, right? You could go to a gladiator school, or in some cases, slaves were forced into a gladiator school, but you got to practice and train with a wooden sword and learn your craft, and then they might start you out in some of like the side arenas that were where you'd fight lower level opponents, but generally by the time you would set foot on the sands of the Colosseum in Rome with a steel sword, um, you'd had some experience. Well, there's no minor leagues in the stock market. Imagine, being a first time investor and you put capital to work and, people don't often think about this, but guess who's on the other side of that trade? It could be somebody like me and I've done nothing but this for 3.5 decades, often working 15-hour days, often working 7 days a week. Um, it could be Citadel or Millennium on the other side. It could be Bill Ackman on the other side of your trade. So you don't know that, but you're going up in the stock market against the very best the minute you have capital at risk, and it's real money, right? You're playing with real money. It's not a game. And, it can be life changing money, both in the positive and negative direction. And so I think it's normal to have emotions. When things go against you, you can feel sick to your stomach. It is a horrible feeling. In fact, Rob, let me ask you, when you've got money invested in the stock market, what kind of feelings do you have about it?
Early days prior to the five things, honestly, it was crapshoot, right? And I think that's where the anxiety builds for novice beginner investors, right? Is that they don't have much guidance. You're kind of throwing a dart at the wall, see what you hit. You hit some, you probably miss more than others, right? Because it's not a fair playing field at the end of the day for a variety of different reasons, right? So I think that's where the consistency, though, speaking the language, staying in tune with the market, seeing how stocks move based on time of year, when earnings come out, what those earnings say, understanding product market fit, and just how to actually analyze businesses early on, right? Those are repetitive things that you need to do over and over and over again to build up skills to understand the market to where now, I do feel much more comfortable, or I know, hey, I'm playing the long game. I don't need to be tied to my phone every single day and the ebbs and flows of the market. In that, hey, I'm confident with my positions. And again, if we start to zoom out, instead of looking at the 5% loss on a day, obviously we don't want that to happen ever, but you start to pull back, right? And you see, okay, 10, 15% gains over the last 12 months or whatever the period is. Which Gary kind of leads me to my next question on this topic. I mean, for novices, beginners, how crucial is it when you talk about that discipline, understanding that this is a long-term game, or you should be approaching investing with long-term goals in mind?
I I think there are different trading strategies, and it's okay to be a short-term trader, but the key thing is you need to master your craft. And so I want to reframe that question, Rob, and talk about, where you were just a couple of years ago in your investing and why you had emotions and what I do about that and the difference between those two states and how it can be used to make money. So when you first started, um, it was basically a casino. You didn't know what you were investing in. You didn't have research on it. You basically were just throwing money at it, kind of like putting chips down on the craps table. Maybe you make a lot of money, maybe you lose a lot of money, who knows? And there was sort of that excitement about it. um, what I do is very different. I spend an enormous amount of time reading, researching. It's decades of experience where I know I've seen situations like this before. These situations worked, these ones didn't. And so, the interesting thing is people often say, well, how do you maintain so much calm? And the answer is sort of I don't, because I have the same emotions as everybody else. I have the same feelings as everybody else. The key thing is to to be able to identify that, to be emotionally aware and realize, okay, yeah, my stomach is up in my throat because I'm worried, I'm upset, I have these feelings. And then once you consciously identify those feelings, you can put them aside. And I say, okay, I feel anxious, I feel upset, I feel worried. But those feelings don't have to drive my behavior, and your behavior is the only thing that matters. And so what I can do in those moments is I set the feelings aside and I go back to the research. I go back to the rational reasons why I was in the stock. And if the stock is down, if it's gone against me, has it done so for a reason that, invalidates my thesis, in which case I have to take the loss and sell? Or has it done so because of a misunderstanding and other people have it wrong? And, the market is reacting to something that's unimportant or temporary. And in situations like that, I may buy more of something when it's down, even if I don't feel good about it. Uh, the ability to put those feelings aside and go to actual research and figure out, does this validate my thesis or invalidate it? And if I were coming to this clean today, would I be buying it or selling it today? That's the kind of discipline that takes a long time to master, and to have the investment knowledge to know, which end of that to be on, and whether you're making good decisions or bad decisions over time. that takes a long time. And so you have to be willing to invest not only in emotional control, but like any athlete, getting the reps, looking at many, many situations and investing across a wide range of industries. Um, and just look and reading these reports again and again and again until you start to see the patterns.
Gary, I want to talk a little bit too about consistency and time. Two key factors for investing. Why are those two key terms that can kind of de-stress investors that are looking and putting consistency and time at the forefront of their investing strategy?
Well, the reason consistency is so important is because investing is a discipline. Um, I talk to people often, and people who aren't professional investors will often say, "Hey, do you have any investment tips?" Like they think we have this like weird secret knowledge, and I could, almost like that Wall Street movie, Blue Anaconda loves horseshoe, or whatever it is. Um, like we're going to whisper something and they're going to make 40% tomorrow, but it doesn't work that way. It is a lot of 12, 13, 15-hour days of reading, researching, calling, being on calls, gathering information, analyzing it, sitting up late, building models. Um, it is a discipline, and you need to be consistent to do that. You also need to have consistency with your investment thesis. One of the ways you really get hurt is having that creeping investment thesis, kind of one of those things where, oh, I'm buying this because it has really high growth and the margins are going to get better. And then, the growth is good, but the margins don't get better. And you're like, well, but the growth is still good. And then the growth goes away and the margins aren't better. And you say, yeah, but the stock is down now. It's really cheap. And you just sort of have the shifting thesis where no matter what happens, you decide, oh, this is what I wanted it to be. It's still good.
Right.
You need to be disciplined to say, wait, this is different from what I had planned. It's time to get out. Or, or to have the intestinal fortitude to say, wait, no, this is temporary. Everyone else has it wrong. And to know to buy more when something's gone against you. These are things that are very difficult to do. And that consistency is the issue. Time, in my opinion, time is one of the biggest advantages deep knowledge investing has. We call it time arbitrage. And the reason that matters is so much of the money on Wall Street right now is very short term oriented. It's only focused on, where a stock or an option is going to be this week, or, whether they think the company will meet or beat earnings this particular quarter. Um, when we start to look out 3 to 5 years, and say, wait, where can we make double our money, triple our money, quadruple our money, or more at times, over a 3 to 5 year period? And don't worry so much about whether the current quarter is good. What we're doing is we're shifting our focus to the place where most investors aren't looking. And that, I think, that gives us an advantage over time. Now, for people who, are saying, well, wait, what's the downside of it? Because everything has a give and take. The downside of that is we're willing to take a greater amount of short-term volatility. I don't concern myself with that. And there are investors who disagree with that. And if you go to, highly leveraged places like Citadel or Millennium, it doesn't work for them because they're using a lot of leverage. And so they have to have a low volatility model. That does not make me right and does not make them wrong. What it means is you need to have the discipline to say, this is my strategy. This is how I'm going to make money in my portfolio and in this name, and follow it. And what they do works for them. What I do works for me. But by using time arbitrage and taking a longer view of things, it gives deep knowledge investing subscribers the opportunity to make long-term huge amounts of money when other people are thinking about which direction is the next 5% going to be.
Yeah, adaptability, Gary, and time, starting early or now or in the next week, right? Getting familiar, I think is super helpful. I know that's one of the things, just my confidence is the time, right? And having these conversations, putting in the reps and then you get an outcome like we were talking about Michigan very early, very, very similar, right? 3, 4 yards at a time,
Yeah.
similar with investing because you're hitting more consistently, you know what to look for. And you also know that, hey, there might be market misses, like you're saying. It's not a cause of panic. It's that, okay, this is actually a great opportunity for us as well. Last question on this topic,
Wait,
Gary. Just
oh,
want to talk
Rob,
about, or yeah, go
before
ahead.
we move on, let's address those two things you just talked about because they're both really important.
Yeah.
Uh, Adaptability is crucial, and I understand that what I'm about to say will sound like I'm contradicting what I said before. Before I talked about being a disciplined investor, knowing your strategy, knowing what you do, but adaptability matters too. And so I'm going to give you a personal example. I started deep knowledge investing January 1st, 2020. At that time, I had never invested in gold, silver, Bitcoin. I'd done very little energy investing. These are now the majority of my portfolio,
Mm-hmm.
right? Because the situation changed,
Right.
circumstances changed. And so I had to learn about new industries, new skills. I had to start, I have never, early in my career, my first few decades, I wasn't focused on the Federal Reserve, on inflation. I wasn't, watching Federal Reserve press conferences or reading CPI reports and taking them apart and analyzing them. These were all new for me, but the environment changed. And so I needed a new skill set. Now, you can complain about it, not profitable, or you can just say, okay, I'm going to read and learn and study and follow new people and look for new sources of information and do that. I also think starting early is really important. To paraphrase an old expression, the best time to start investing is when you're young. The second best time is now. Uh, Over the long run, you tend to do really well if you invest well. And we all have down years. We all have down periods. It's happened to the very best investors in the world. That's certainly happened to me. Nobody's above that. But when you start early, you give yourself the opportunity to bounce back from these things and make a lot of money over time. So I think, those two things that you just brought up, and the reason I interrupted you on that is because these are crucial factors. And if you're a novice investor, these are things to think about and to start to understand, or at a minimum, if you don't want to do it yourself and you go to an investment advisor or you go to, if you come to Deep Knowledge Investing or another firm like ours, that's great, but ask these questions. Ask about the things that we're talking about and make sure you understand the answers. Make sure the person who's managing your money can articulate good answers to that. If they can, then, they're probably a good fit for you and they'll probably do a good job for you. But if you get nonsense answers, then that raises a red flag. And it doesn't mean the person you're dealing with is dishonest, but it does mean you need to ask more questions and figure out if you could or should get comfortable with the way your money is going to be managed where it is.
As Gary mentioned, we have our portfolio, Gary's current recommendations, position to minimize market risk, hedge your portfolio. That can come with a premium subscription on our website, $100 a month, and you'll have access to all existing positions when we buy, when we sell, and movement within the portfolio as Gary aligns us for future inflation, all the different things we talk about on the five things. And also, please don't hesitate to reach out through our Ask Gary feature on the website as well. Any questions that you might have, whether it's portfolio positions, investor knowledge, how do I do this? How do I do that? We'd love to hear from you. And a lot of times we'll take those into consideration when we're writing this five things. You might even see your question as one of our topics for the week. Gary, closing out thing 4, moving to thing 5. A little bit different here too. Just wrapped up, obviously, Thanksgiving week. Gary, I know it's a important holiday for the both of us. Lots of gratitude and thankfulness for the people in our lives. Gary, take it away though. Thing number 5, very simple, Thanksgiving.
So, Rob, it's kind of funny that people will be hearing this or seeing this, the week after Thanksgiving, and some might say, well, why didn't you do this segment a week ago? And the answer is because I wanted to write it on Thanksgiving. I think being grateful is one key to living a good life and, finding ways to be okay with even the bad things that happen or ways that they might not be bad things is really important. Um, I've been running deep knowledge investing for 5 years, and I am so fortunate to be surrounded by incredible people doing a job that I love. Um, in particular, I want to thank the Deep Knowledge Investing Board of Advisors. Not only have they been a source of high return ideas, including huge winners like Shockwave, TPL, Texas Pacific Land, They've been a source of information in a wide variety of industries. They've also provided me guidance on running the firm, and my best friends are on the board. I am surrounded by people who absolutely want to see me succeed, want to see the firm succeed, want to see our investors and our subscribers succeed. And they drive me and, push me to constantly do better. And I am so fortunate to have them behind me. And I'm grateful to every single one of them. Rob, I also want to talk about my relationships with our interns. I think we've had 9 of them so far, college interns, and working with them has been incredibly personally rewarding. Being a mentor to them and helping them prepare to succeed in their first jobs has taught me a lot about leadership. And these young people, I keep hearing, Rob, how, they're all snowflakes and they want participation trophies and they think they're fantastic for showing up. Not these guys. Um, they are driven. They want guidance. They want help. When they make mistakes, and I go to them and I correct them, rather than be defensive or angry or upset or feel hurt, their response is always the same. Thank you so much. Right? They thank me for helping them prepare. And what that's allowed me to do is it's allowed me to be very demanding on them regarding their work product, but also supportive of their professional aspirations. I've had the pleasure of talking to them, helping them prepare for job interviews. I've talked some of them through breakups with their girlfriends, or family issues or personal issues. These are important people to me, and working with them is incredibly rewarding. And one very bittersweet piece of news: Andrew Brown from the University of Tennessee is going to be moving on. Andrew's been an incredible contributor here at Deep Knowledge Investing. We are so fortunate to have had him. But he called me, and he said the reason I need to move on is because he has an opportunity to manage money from Tennessee alums while in school. And I said, well,
Yeah,
you have to take it. You
it's
have
awesome.
to. You just it's too good an opportunity to pass on. And so, he leaves with our gratitude and our respect. And when I called Alex and our other intern and said, hey, listen, Andrew's moving on, the first thing he said was, okay, I'm prepared to do more. I'm prepared to take on more responsibility. No complaining, no worrying, just I'll pick up the slack. These are incredible young people, and I've been able to stay in touch with them, um, while they've left, and they're succeeding in business and finance. Some of them started their own firms. Others are a big name Wall Street firms. It's great to see them. Other people that I want to recognize, Rob, of course, you. I joked in the written version of the 5 things. Our first conversation featured yelling at each other. But
Passion.
yeah, exactly. But you know what? We've become friends and partners, and you're here every
100%.
week with me, including today on a Sunday morning on a holiday weekend. Um, Rob, you've been a huge contributor. And by the way, for everyone who enjoys the 5 things, it was Rob's idea. For everyone who likes the video version, it was Rob's idea. One thing I'm really good at is taking advice from people who know more about their field than I do. And when Rob comes to me and says, hey, we need to do this, we need to do that, I'm like, okay, explain it to me. Help me understand. We'll do it. And so I've benefited from that. And your not just professional, your personal contributions to deep knowledge investing, it's been incredible. Um, One of the other things that's been hugely rewarding and fun for me has been we've gotten dozens of podcast invitations, and I've gone on lots of shows, and that's been really fun. But people like Michael Guyed and Phil Muscatello, Andy Wang, Tony Nash, Tracy Schuchart, the team at Amaranth Bitcoin, they've all had me on multiple times, and that's terrific. They've given me a platform to talk about deep knowledge investing and our ideas and our approach to the markets for a whole bunch of people. And I've done a couple of recent podcasts where people were, they had an audience of entrepreneurs who felt like everything was getting hard and didn't understand why. I said, okay, we can explain to you why this is happening, why you're not crazy, why what's happening is not your fault, and most importantly, what you can do about it. And to be able to get those ideas out there and help a new audience of people has been a lot of fun. And, I named just a few of them, but there have been dozens of people who have kindly invited me to do their podcasts and their shows, and that's been terrific. Most importantly, the reason Deep Knowledge Investing exists is to help our partners and subscribers earn better returns. And it has become the kind of cerebral community that I always hoped it would be. Our amateur investors are incredibly smart. And, when we do webinars or, I open up the forum for questions, the questions I get from them show they've done a huge amount of work and a huge amount of research. And it's a long running joke, but not entirely that, I could go on vacation and let some of our bright amateur subscribers and amateur investors run our webinars, and you know what, they do a great job of it. We'd be fine. To have a community of investors that reflects my approach to investing, where people understand risk and reward and ask really smart questions and are just in it for all the right reasons, has been incredible. And for our audience here, if you're listening to this, thanks for being part of Deep Knowledge Investing. We are fortunate to have every single one of you, and we appreciate you.
Yeah, Gary, very well said. I personally, as well, would love to thank the deep knowledge investing community. Also, a lot of times I get to see the questions beforehand and talk with Gary about them or see the responses. So I know for me personally, it's been just a huge knowledge base. I've learned so much about topics and investing in general that I knew nothing about, right, 3, 4 years ago. And feel like, I'm starting to be able to plant my flag in the ground a little bit, right? And make my way through things and start to understand. And that's because of everybody, the people that watch this show, send in the questions to Gary, comment on blog posts, and obviously our premium subscribers as well. Thank you so much for the support. You guys are the ones that allow us to actually be able to do this on a consistent basis. Same thing, Andrew, Alex, all the other interns over the past, echo Gary's sentiments there, even on my side of the business as well. We have an intern program, and yeah, they're hard workers. They want to take on more. I think they're just looking a lot of times for that guidance. So I think anytime you can give back to someone younger that wants to learn and will show you that they're willing to do what it takes, it's one of the best investments you can make. We talk a lot about investments here, obviously. So, and Gary, finally to you, thank you personally. It's been a lot of fun doing this show. I think we're just getting started. We're on the up and up, but want to say personally, thank you for your time, helping me build my own knowledge base, build long-term potential wealth opportunities, right? You've been really critical for me, just improving my game, right? And putting in the reps and the time and the energy. It's one of my favorite things to do on a weekly basis. So for me, it's not work at all. I really enjoy this because I can see the fruits of the time that I've put in. And I think it goes to show that anyone can as well, right? My background's marketing, business, nothing to do with investing. But you put in the time, you read the information, you think critically about it. You can definitely make big gains in the markets and understanding why you're doing certain things and having an actual game plan in certain instances. So Gary, yeah, thank you personally for allowing me to be a part of this. I'm really looking forward to what's to come, and again to our community. We wouldn't be able to do this without you. Gary, that kind of wraps up this week's show. I'll leave it to you for any closing thoughts.
Well, thanks, Rob. Great, great tribute there, and I appreciate it coming from you. It means the world. Again, for our viewers here, thanks so much for being part of Deep Knowledge Investing. And I guess the final word of the day is to thank Sharon Moore and the University of Michigan football team for one amazing
That's right.
day yesterday. And go blue, and we'll see all of you guys next week.
Thanks, everyone.